Hi there, everyone, and welcome into this week's market update. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances, and you need to decide for yourself whether it's appropriate to you. Alrighty, so it's been an interesting market over the last few weeks, guys. It has been a few weeks since we've done one of these updates. So, at this point of time, not much has changed, but a lot has changed, if that makes sense, right? But our market's just going dead sideways. It is stuck between 72, which is a bit of a level of resistance right now, and support down near 7,000. Also stuck inside of a bit of a pennant pattern where we can see a downtrend line is meeting a bit of an uptrend line through here. This is a definite decision, sort of indecision level, right? If we break higher, it means there's probably some good news around, and the market's looking a bit more bullish. If it breaks lower, then well, things are looking a bit more bearish, obviously, right? So some key levels from a technical standpoint, obviously, are 7,000 or 69.80 thereabouts. If this level breaks, then it's starting to look more and more like a bear trend. Really, though, for our market, I want to see 68 taken out. If 68 gets taken out, then I'm thinking really quite bearish. At this point, it still kind of just feels like a bit of a correction for us. The US market's actually looking a little bit more nasty than what we are right now. We've been quite resilient up until now, and we're just monitoring to see whether that's going to continue or not. So US is probably more the one to watch right now, guys. That's what we've got our eyes peeled on. We just want to see what happens there next. Okay, so let's start with the S&P 500. This is top 500 stocks of the US market. I put more weight on this index than I do any other for the US, right? The Dow's only 30 stocks. It's more industrials, and it hasn't got quite the diversified mix that the S&P 500 has. Then the Nasdaq's mainly sort of techie and growth stocks and that sort of thing. So for me, the S&P 500 represents a better true representation of what's happening in the US, in my view. So right now, we have a bear trend. It already has developed a bear trend. You've got a lower trough, lower peak, lower trough, lower peak. The only thing is that trough there was only an intraday low, okay? Because really, if you take the intraday movement out of it, the actual trough may be up here. So it's still not 100% for me confirmed bear market for the S&P 500. It is at the last line of defense though. Okay, so 41.73, you can see that level drawn in through there. If that's taken out, there is no way we can debate that this will become a lower trough scenario. So that means we have got consecutive lower troughs and lower peaks, guys. We have not seen this on a US index for a very long time. Even throughout the COVID pullback, that COVID pullback lasted a month. It took a month to wipe off almost 50% of their market, guys. Right? That was a free fall. That was a complete fear free fall. Wasn't even a bear market. I don't even think we got lower peaks and lower troughs. It just fell. This is a little bit different. This behavior is a little bit different to what we saw back then, in that there's so much uncertainty here that's playing out that could continue to play out over the long run. There could be that slower grind lower. So the way we trade this changes completely, right? It's one thing to have a complete free fall, right, where the market just plummets 50%, bang, it's over, then it slowly climbs back up. Yeah, down the elevator or down the bloody off the side of a building, up the staircase, right? Here we're stepping down, right? We don't see that out of a market very often. We see stocks do this. It's very rare to see an index do this. The last time I saw this on an index was the XJO, when we saw back about 5 or 6 years ago, when we had the banks having to raise capital because of the APRA requirements, and we also had a big crash in commodities at the exact same time. And that led us into a bear market on the XJO. This is what it reminds me of. So guys, this is where we've got to be open-minded, okay? If we see signs of the technical bear trend continuing, we have to lean more towards bearish trades. We have to be more realistic of what's going to happen, okay? But there's a massive but here. Any hint of a resolution in Ukraine and Russia, this market will rally. Okay, so the technicals will play out until something fundamentally will change. At this stage, I don't see anything changing. There's a lot of uncertainty out there. The Fed's probably the last piece of the puzzle this week, right? So they're kind of a little bit on a waiting pattern until Thursday morning when we get feedback from the Fed. All right, we'll talk about that more in a moment. I want to go through the technicals first. Now, here's the NASDAQ. As you know, as I said before, this is more heavily tech and communication services and discretionary type stocks. Okay. This is more your growth space. Now, with the view that interest rates are going up, naturally, this space will do worse than the more traditional value stock space. So, in these environments, banks will tend to do better than your discretionary growth type stocks. Okay, and that's more related to inflation and interest rates. Okay, your growth stocks don't like the increase in interest rates. This is a clear bear trend, guys. As of last night, this to me is now in a bear trend. Right? There's no debating it. There's no way of looking at it differently. This is now in a bear trend. Okay, it is getting into a bit of an oversold condition, so I wouldn't be surprised to see a little bit of buying soon. But it doesn't matter how you cut this. This is now bear trending. So we trade it as we would just opposite to a bull trend, right? That's the mindset we've got to get into. If it gets oversold, we look to buy short term. If it gets overbought, we're happy to go short in the medium to longer term, right? Because it is a bear trend. And then your fundamental overlay is 100% inflation and the Ukraine-Russian situation. If we see an improvement in inflation, if we see the central banks back off around interest rate hikes and don't get too hawkish, then things could change. But until that happens, this is likely to downtrend. So maybe another day or two down, and then up again. Step up, step down, step up, step down. Okay, we've got to change our mentality here. It's hard with the psychology behind it because we've been buying the dip for the last 2 years. Now you've got to start thinking differently. We're not sitting here trying to buy the dip anymore, guys. We changed out of that strategy a few weeks ago, maybe a month ago. We've stopped trying to buy the dip. Okay. Now it's more about when do we go short? When's a good time to play a very quick long trade, right? Because we're now bear trending. All right. So sorry about repeating myself, but it's the best way of getting the message across and adjusting psychology is by saying it a few times and hearing it a few times. All right. So let's have a chat, guys. The Russia-Ukraine situation. Really, at the end of the day, it doesn't directly affect us unless things escalate in the sense of war. What it's doing, the side effect of this, the contagion effect of how it affects the world is more in the commodity space and not just energy, but food. So things like wheat and grain products and things like that are a major export from Russia and Ukraine. And at this point of time, with this conflict going on, none of that is happening. So what we're seeing is a massive push up in a lot of food prices, not just because of the energy situation, but highly because of the fact that they are a huge exporter, just as we are in Australia. Okay, so that has to come into consideration. That's going to cause inflation to go up. Okay, so that's one element to talk about here. So for me today, right now, for the markets this week, even to say, it's for me, the markets are going to react more about this inflation and central bank story than it is what's happening in Ukraine itself. So, as you already know, oil prices hit 125 the other day and it's backed off a little bit. So let's digest that for a second. So there's two reasons why I believe crude's coming back off a touch right now. One is because of the OPEC meeting, the OPEC announcement last week that they're going to consider increasing output. So that's going to help the oil situation and bring the prices down a little bit. The other thing is that there's a few articles surfacing about China buying Russian oil in the local Chinese currency. So what that means is that in a side effect, you've got the Russian oil still coming into the Chinese market. The Chinese market won't have to buy it from other areas as much. Therefore, these still have a bit of a flow-on effect, and that brings more production on. We don't know what's going to happen there, guys. That could escalate, right? The US might put sanctions onto China to stop them from doing that or to persuade them not to. Who knows, all right? There's a lot can come our way in the next few weeks. So that's one element of it. The other element of the reason why crude's coming down is the huge lockdowns that are happening in China. So in through China, they're having another massive wave, and you're seeing many cities getting locked down. Okay, which means less use of oil and petrol and things like that. So there's so many things at play right now between COVID and the whole Russia-Ukraine situation that could calm oil further. all right, for the time being in the short term. And that could help the inflation situation a little bit as well. So this is what we've got to watch out for, guys. I'll just quickly bring up a website. And look, this is going to be a long video today, but I promise you it'll be worth it. So there's another website. This has been quite handy recently that I've come across. And you can see that here in the video. So the link is tradeeconomics.com/commodities. That's got a lot of what you want to look at a glance, and you got it from a daily perspective, weekly, monthly, yearly. Now have a look at the gas prices through Europe. I just want to highlight this real quickly. The natural gas prices hiked 500% year on year. But in the last couple of weeks or days, I should say, from the 7th of March, which is the 15th now, so since the last 7 days, it's halved. It's gone from 534 down just below 300 there. So there's already a correction happening, guys. Prices are already starting to come down after that OPEC meeting. Okay, go have a look at crude, 97.91. That topped out. It's down 5% over the last day. It's only up now 6% for the month. It was up a lot more than that. Okay, it was at 120. It's now down to 98. So what we've got to be watching is the more that these energy prices come back down, okay, the more we're going to see the likes of inflation cool off. It's going to take the pressure off markets. It's going to take the pressure off central banks. And that's the sort of the boiling pot that I'm looking at the moment, guys, right? The more inflation pressure we get, the more hawkish these central banks will become. Therefore, we've got a double whammy for the economy. One, the everyday consumer is going to get squeezed by higher prices. But two, a lot of these consumers are also going to get squeezed if the central banks increase interest rates, especially here in Australia. If the RBA starts to increase interest rates, because a lot of people are still on variable loans. In the US, it's a little bit different. In the US, a lot of people have their loans 30 years fixed. Okay, so the variable rate of the Fed doesn't affect them on a month-by-month basis. So it's a little bit different to the way we work here in Australia. But what I really want to sort of highlight here on this page as well, and something I think you've really got to keep an eye on, is this space here. Okay, now we're starting to see some corrections happening. Okay, so 68% on wheat futures. Okay, year on year, but in the last week that's come back down by about 8%. So this is what we're going to keep an eye on. We want to see these types of prices on the main things like rice, corn, wheat, things like that. We want to see these prices start easing off. If they ease back off again, okay, once again, it's going to take the pressure off inflation. So this is what I'm watching in the short term, guys. I've got my eyes glued on this every single day to get a feel for where markets are likely to break next. And I think, once again, unless Russia starts talking nuclear, I don't think the whole Ukraine-Russia situation in the short term is really playing that much more of an effect. I think it's going to be more about what the central banks of the world want to do later this week. You've got the Fed Thursday morning. You've got Bank of Japan on Friday, and I believe you've got Bank of England on Thursday as well. So you've got three majors of the central banks all talking later this week. Let's see what they come up with. That could lead our own central bank to do something in the coming months as well. Let's see how it plays out. I think the market will be hanging on to that for the rest of this week to see what happens. Okay, so it keeps raising the questions, guys. Is this going to be a bear market? And I think I spoke about this enough before, but I'll just reiterate. Our market is still got a bit to go before I'd consider it being in a bear market. Our market is holding up fairly well because the higher commodity prices will help not only our miners, but will also help the overall economy, as we'll get more tax revenue out of that. So Australia is well placed if commodity prices actually remain elevated for a period of time. All right, so we've just got to keep that in the back of our minds. And if this war continues to escalate, well, hey, that's probably going to happen. Not to mention, we're a huge exporter of agricultural goods, so the prices there will also help us domestically. So that's why we're probably a little bit more resilient. We are a value-based market, so if interest rates do go up, that's going to help a lot of our market as well. So It's a little bit different for the US though, where they're very much a growth-based market. So their growth stocks are getting hammered right now. The Nasdaq type tech stocks are all getting walloped right now. Then you mix in the whole China situation of China locking down and further potential supply chain issues. And this is where things get really hard to predict right now. What you got to remember, guys, markets do not like uncertainty. Okay. They don't mind bad news. Okay. Because we can price in bad news. We don't mind good news. We can price in good news, but we don't like uncertainty. The China lockdown just put another huge level of uncertainty for me on this market. And this is where I've got a bit of a sort of, it could go more bearish, guys. I just got to warn you. This bear market could be a theme for another 2, 3, 4 months, right? Now, that is on the table. And we've got to lean on our technicals for timing because, yeah, if we don't get a resolution in Ukraine and Russia in the next few weeks and China locks down for a month, it could really disrupt a lot of supply chains, and that could affect us for the rest of the year. So there is some risks there, guys. Some big risks for our market. I don't think it's going to be a massive free fall as what we saw out of COVID, because COVID just shocked everybody and everyone just hit the sell button at once. What's happening right now is unpredictable. It's very hard to know what's coming next. The people that wanted to sell on the back of the Ukraine-Russia situation have probably already sold. And it's just a matter of whether the market forces will get more people selling again or not. And this is where I think we'll get that step down approach more than that massive crash we saw back in 2020. So expect a step down scenario if the bear market continues, not a free fall. That's the message, and that's tradable, guys. It affects the way you approach it. You can't just go bearish and sit it there for the next 2 months and hope the market's going to move down, as many of you probably did in the bull market. We've got to trade the peaks and the troughs. We've got to trade the market overbought, oversold on the way down. Okay, that's kind of how you got to adjust your mindset, and then just see how it plays out. Because at a dime, this thing could change very bullish at any moment. So keep some powder dry. Don't put all your bank in the market at once right now. It's a high volatile, high risk market. Find lower monetary risk trades. Keep some powder dry, ready for when it does bottom out. So I can tell you now, when it does bottom out eventually, whether it be weeks or months away from now, from here, there's going to be a huge opportunity. Okay, so keep some powder dry, guys. That's my number one thing right now. Huge opportunities coming for this market. All right, so that's probably it for me, guys. There's so much going on out there. There's probably so much more I could think about talking about right now. But the main things I've covered. This week, it's about the Fed. Let's see what the Fed comes up with Thursday, whether they're going to increase rates or not. Everyone's talking 0.25%. They could do half regardless. We've got about 4 or 5 even rate hikes this year priced in for the Fed. That's not the problem. We want to know what the Fed's likely to do next. Are they going to become extremely hawkish, or are they going to keep this wait and see type mentality happening? Because the wait and see will be safe for markets and cushion things a little bit. But if they start talking too hawkish, markets aren't going to like it. The US market especially. All right, so that's it from me. Thanks for listening in. If you made it this far, take care and bye for now.